Welcome everyone to our Home Buying in 2020 webinar. I also want to thank Charles from Centennial Lending and Courtney from Camber Realty for also joining us as well. I appreciate their expertise because they are the true experts when it comes to the whole home buying process. So of course, Fitzsimons is the one that helped put this together. Just to give a little bit about us is we are a local credit union based in Aurora, Colorado, but since September, we actually now serve all of Adams, Arapahoe, and Denver counties as well, not just Aurora anymore. We are a full service financial institution. For those who don't know what a credit union is, it's basically like a bank. The only difference is it's not for profit, which means any profit we make at the end of the year goes back to our members in one way or another. That could be, keeping our interest rates and loans as low as possible, giving back when it comes to dividends or interest on savings and checking accounts, so you get more money in your pocket. And of course, trying to keep those fees down to a minimum as much as possible. But yeah, we offer pretty much everything that a bank would offer. Just the main difference is we're not for profit. And when you're with a credit union, you're a member. So what that means is, as a member, you are part owner of the credit union. You're not just a customer here. Another nice thing about us is we are a co-op, which basically means you can pretty much go to any other credit union and do your basic financial transactions just as if you were at your home credit union. But I'm going to turn things over to Charles so he can talk a little bit about himself and what Centennial Lending has to offer as well.
Thanks, Jen. I appreciate it. Hi, everybody. My name is Charles Wright. I work for Centennial Lending. We are a credit union-owned lending company. We help approximately 100 different credit unions kind of around Colorado, Wyoming, Nebraska, kind of the Intermountain West, offer mortgages to their members. We also offer some commercial loans and some other stuff. We'll talk about mortgages today. I've been involved with Centennial Lending this time around 10 years. I was here briefly 3 years before that. There's a little intermission in there. Worked for a credit union. Been an MLO for 20 plus years. Primarily do all the residential mortgage trainings for Centennial Lending. Been in the credit union industry for coming up on 25 years now, and I'm a certified credit union executive, which means a lot to me. I don't think anybody else is going to care about that, but I would consider myself a mortgage lending expert, and I should be able to answer any questions that you have on the mortgage process or the mortgage industry.
All right, and last but certainly not least, we have Courtney Morehouse with Camber Realty.
Hi, everyone. Yeah, Courtney with Camber. I've been a realtor for 12 years, specializing in residential in the Denver market in Colorado. Happy to be here. Thanks for having me, Shanna.
All right. So before we get to the main presentation, I just wanted to point out a great resource we have on our website. So we have a whole section dedicated to financial education. So you can always visit there for different resources. And we actually have a handy dandy home buyer guide. Let's see. Just waiting for it to load. Just wanted to show that real quick. And this was also helped put together by Courtney. So she had her own version of this. We just put her own flair to it, but I did want to give Courtney credit as well for putting this together. But she has the whole home buying process nicely laid out. We also want to make sure when it comes to the home buying process that, being a homeowner is right for you. So there's just some questions that you might want to ask yourself to make sure that this is the right direction you want to go. We also try to make sure you're aware of the total expenses of what it comes to being a homeowner. It's not just, the mortgage, it's all those other additional fees and, just the cost of being a homeowner in general. So yeah, it's just a nice guide that you can work through when you are ready to go through that complete process. Kind of points out all the financials, also brings up resources, all that sort of thing. So for anyone that pre-registered, we'll probably send this over to you. But if you ever need to get a hold of it, you can just go to the Fitzsimons Credit Union website and just go to our financial education section, and then we have this available to you. All right. Go back to the presentation. Thank you so much for your patience. All right. So what we'll discuss today, we're going to discuss the overall home buying process, the resources for homeownership, what the housing market is like in 2020, because as you all know, the Colorado housing market is wild in general, but in this year, I'm sure it's a completely different thing altogether. Tips to being a successful homeowner and, when home refinancing makes sense for you. And of course, at the end, we'll reserve time for any questions that you may have. All right, I'm going to turn everything over to Charles, and he will, begin the journey of this home buying process. All right, Charles, it's all up to you.
All right, thanks very much. Appreciate it, Shanna. I'd like to walk everybody through the process of buying a home. And I'm going to try to keep everything down to kind of layman's terms and kind of walk you through some of the benefits and what to expect and how to kind of get ready for everything. I'll turn it back over to Courtney in a little bit to talk about the market and housing and the actual process of buying a house. But the first thing to understand is you have a lot of resource out there for people that are willing to help you, that want to assist you in this whole process. And so where we're going to go through a lot of things, credit, what to look for, buying house and all that, understand that the takeaway of today's presentation is you've got someone like Chris over at the credit union, you've got someone like Courtney waiting to help you, to walk you through this whole process and hold your hand. And so it's very typical for someone to reach out to their loan officer really as the first step and figure out what they qualify for and figure out all their numbers and figure out everything. Let that loan officer help you. Then it's a logical next step to reach out to your realtor and have them walk you through what houses look like and kind of guide you through the whole process. Both those people want to help you get this whole process taken care of. So don't get hung up on the fact that it might be a little bit scary and we're talking about credit scores and all that other stuff. Understand that the takeaway is you have a lot of people that are willing to help you process this transaction and help you buy that house. Okay, so first thing to talk about, let's talk about credit. Credit and your credit scores matter immensely when it comes to doing transactions, things like buying a house. And so what is a credit score? It's a numerical expression based on kind of an analysis. I'll show you that in the next slide on your history of how you've been paying off debts, how you've been paying your credit. How do you establish and regain good credit? Some people, if they have some missed payments, if they have a history of some delinquencies and all that, how do you regain your good credit? It's pretty simple. The first thing you can do is literally just pay your accounts on time and then kind of work your way through keeping yourself up to speed and keeping yourself up to date. If you ever want to look and figure out what your credit looks like, you can go to annualcreditreport.com. You can get a free copy of your credit report. It doesn't have a score. As the beginning of the mortgage lending process and in the beginning of the home buying process, it would be very beneficial to either reach out. I know the credit union has this service also, but take a look at your credit report and see where you are. If you're a person that has a history of making payments on time, don't worry about it so much. If you're a person that has a history of a couple of dings on where you've been a little bit late, you've got a couple little things going on, reach out and get that free credit report. Hey, Shannon, next slide, please. Okay, so what makes up your credit score? And I love this slide because it really gives you a basic breakdown on kind of what's going on that comes together that creates that credit score. That credit score is being looked at by your credit union, it's being looked at by your mortgage lender. It really helps to establish the fact that you make your payments on time. It helps the lenders understand that, yes, you're a good lending risk and we're willing to lend money to you. So 35% of your credit score comes from simply your payment history. Do you make your payments on time? And do you have a history of making your payments on time? The next 30% of your credit score comes from the amount owed. Again, it makes sense, right? If you owe a ton of money, it's going to be hard to keep up with your payments. And what's a good example of that? If I have 2 credit cards and they each have a $3,000 limit, the maximum I could owe would be $6,000. If you compare that to, maybe I'll pick on Shanna today, if she has 4 credit cards and they each have $10,000 balances, she could owe potentially $40,000. Well, there's a huge difference in paying back a loan of $6,000 and paying back a loan of $40,000, right? So that comes into effect when we're trying to figure out your credit score. Now, and then the rest of it to a minor degree, length of credit history matters. And so have you established credit? Can we see that you've been paying your bills on time? New credit matters. And so during the transaction or in the last second, have you run up your credit cards? Have you made a big purchase at the last second? And then the types of credit used. Credit scores like to see a little bit of diversity when it comes to credit. So what really matters and the real takeaway on this whole thing, if you're making your payments on time and you're not overly leveraged where you owe just a ton of money on your credit card or a ton of money on your car payments, your credit score should be just fine, right? The other takeaway is, if you're thinking about buying a house and you're not in the credit world, if you're not using the system, now's the time to go out to the credit union, get yourself a debit card, get yourself a credit card, and start the process, okay? The idea that a lender like myself or like the credit union wants you to pay cash for everything and wants you to have mattress money, it sounds like a great idea, but us lenders, we want to see that you're in the system, you have a history of making payments on time, and that you're kind of working within the rules like everybody else is working. So new borrowers, if you have no credit, go to the credit union and establish credit and start paying your bills on time. Existing people, if you're using your credit, you don't need 10 credit cards, you probably only need 2, right? If you're leveraged to the hilt, it's time to start paying those houses down a little bit. Next slide, Chip. Okay, so if your credit score isn't perfect, and credit scores are a funny range, right? There's these arbitrary numbers, 500 to 800, 5 something to 850, right? Really anything above the middle of the 600 means you're going to qualify for a mortgage with no problem. So don't get too hung up on the fact that you might have a 700 credit score, or 705, or a 710, or in my case, my spouse has a better credit score than I do, and she loves to point that out. If you're going to get approved, you're going to get approved. Don't worry about it. But if you're not in that level, or you want to try to improve your credit scores, what can you do? Okay. First things first, only apply for credit when needed. So why does that matter? Well, new credit affects your credit score. And we see that a lot, right? We see people that are going to get ready to go buy a house, and right before they're about to close on their transaction, they go to Home Depot or they go to Lowe's and they go buy a bunch of building supplies or furniture, and they get a Lowe's credit card. Well, now all of a sudden you've encumbered more credit, you've got more payments out there, you've kind of skewed the whole platform, and you change your score, right? So only apply for credit when needed. You don't need a Kohl's credit card. You don't need all those extra corporate credit cards that they offer you on checkout. Limit yourself to a couple cards, limited balances. Second thing, most important thing, pay your bills on time. Third, keep your balances low, right? Don't establish too much credit. Don't have massive balances. Pay off your debt rather than moving it around. So the modern credit scoring systems are smart enough to figure out what you're doing with your money, and they can see that everything's going back and forth. Things like rate shopping for cars or for mortgages during a focus period of time, 15 to 30 days really doesn't affect your credit score. And so if you're looking at a car loan from the credit union, the rates are great. But if you're going to move Shop around a little bit. Don't worry about it. A couple people pulling your credit for car loans makes sense to the credit bureau. It's not going to affect your score. And then reestablishing credit if there have been problems in the past. So opening new accounts responsibly will improve your credit cards over time. Now, I want to say one little weird thing about the credit scores, right? If you have a delinquency that's more than a couple of years old, you would think the best thing to do would be to call that delinquent account, call them up, say, hey, look, I want to pay this thing off, and I want to get everything taken off my credit report. The problem what happens when you do that is that delinquent account, which is long past and long done, now gets moved forward and becomes active again, and it shows up as a more active delinquent account. And so I know it's contrary to what makes total sense. Obviously, you want to pay off delinquent items and all that. But if you're getting ready to go buy a house and you're getting everything pre-approved, the last thing you want to do is mess around with any of your credit scores. So throughout this home buying process, when you call your loan officer, when you call Christopher over at the credit union, and you're walking through this whole entire process, once you're approved, don't go out and establish new credit. Don't mess around with your credit report. Next slide. And so just to reiterate that, payment history accounts for 35% of the weight of the final score. So just pay your bills on time, and that's really going to affect your credit scores immensely, right? Credit scores include information for like public records, bankruptcy, foreclosures, tax liens, and things like that. If that stuff's out there, we need to get a little beyond it. And then just like I said a second ago, the amount of time since the most recent derogatory public record matters. And so if you have something that was late and was long ago, 2 or 3 years old, you're better off just leaving it be, qualifying for the house. Once you get through the purchase transaction, go settle that after the fact. Next slide. Fitzsimons is a fantastic credit union, and you can check your TransUnion credit score for free. This is a great service, and you should reach out to your credit union, and it's got a fantastic engine right here, and they can walk you through it. It's one of these great benefits of being part of the credit union, and you can go take a look. And just like I said, you don't really see 300 credit scores, but 500 is about as low as you get, and 850 is about as good as you get. And you really need to be up in the middle of that fair mark, around that 650-ish range, 620-ish range, to qualify for mortgages and qualify and get the first-time home buyer process going. Obviously, a little bit better of a score is more important. So I'm going to move on beyond credit. I think that stuff's important to take a look at because it comes up sometimes. I don't think you should obsess over it. If you're paying your bills on time, you're fine. If you're not paying your bills on time and you're thinking about buying a house, now's the time to start paying them on time and cleaning things up a little bit. Get a copy of your free credit report, take a look at it, walk through it with one of the folks over at the credit union, and figure out how you can clean it up. Next slide. Okay, so I'm going to move beyond credit for right now, and let's talk about getting ready to buy a home. Buying a home has a lot of advantages. You build equity. So when you buy this house, you're paying down your loan. The house value hopefully is going up a little bit, and you're building this kind of very illiquid savings account we call equity. And that money kind of sits there until you sell your house or until you need to leverage it sometime later. Well, that's a great determination of wealth and future wealth, is owning a house and having that equity piece, right? Right now, when you're paying rent, the same payment on a mortgage, rent just goes to your landlord. You're not building any of that kind of savings account. Buying your own house, now all of a sudden, instead of paying your rent, you're paying your loan down, and you're building this illiquid savings account, and you're building a bunch of wealth, and you're building a bunch of equity. Other side of that is a sense of community and stability and security. There's a certain pride of ownership when you buy a house. You want your neighbors to mow their grass. You want to mow your grass. You want to take care of everybody. You want to make sure your kids are playing with the nice kids in the neighborhood. I know you kind of feel that way with rentals. It's a little bit different when you own that house. Independence, no landlord. That's a great thing. You can paint your walls purple and black and do whatever you want. You don't have a landlord calling you all the time. And then you can make updates as you want. I'm a gardener. I like to have a big garden. My neighbor is not, and he's got a bunch of rocks in his backyard, and that's his choice. He's an homeowner. Couple considerations when you own a home, though. You're responsible for the maintenance. And so when your plumbing breaks, you can't call your landlord. You got to fix it yourself. You have taxes and property taxes as part of your mortgage payment. If you're not making your payments on time, the bank or the credit union can come and take the property back and foreclose and kick you out of it. And you have a lot less mobility. So if you're somebody that moves around a lot, owning a house is going to anchor you to a neighborhood and anchor you to a location versus the ability to just pick up and move and rent. Rent, obviously, you have little or no responsibilities for maintenance, easier to move. Rent also has no tax benefits. You don't have that equity piece. You have no control over rent increases, and the landlord could sell your house and possibly evict you. Next slide, Jen. Okay, so what do you do to get ready to go buy a house? The first thing you do is you make a budget. And this could be a pretty simple budget, but you want to write down where your money is going to, right? The idea is that this new home doesn't have to hurt. You don't have to leverage yourself so far into this new house that you can't afford to go buy groceries and you can't afford to have a little bit of life that's going on. But you want to sit there and figure out, okay, what's my income look like? What's my rent look like? And where are my expenses going to? And so I say, when you identify your expenses, right? Write these things down. Go spend a couple weeks and write down everywhere you're spending money. The great example that we choose to always talk about is, how often are you going to Starbucks? If you're spending $6 a day at Starbucks, well, shoot, that's, I don't know, 6 times 7, $50 a week almost, not that much, but $40 a week. Now you're spending $40 a week just on coffee. Could you spend a couple bucks a week and make your own coffee instead of going to Starbucks? Are you going out to dinner all the time, right? Are you spending $40 a night every time you go out to dinner, or going out for lunch every single day and spending $10 every time you go out to lunch? Identify those expenses. If you're being serious about buying a house and you need to qualify and you need to start saving a little bit of money, now's the time to make some simple, logical choices and maybe make a couple changes to kind of simplify your life a little bit and save a little bit of money. And the really important thing is, write it down. If you don't write it down, it never happened and you're not figuring this thing out. Buying a house is a big decision. If you're married and your spouse is a part of this, or your significant other is that, take the time, figure out your budget, write down where your expenses are, take a look at that and see if you're going to be able to afford the payment, and then also take a look at that and make some logical changes if you have to. Now, don't get me wrong, I'm a coffee snob, and I would be upset if I couldn't have my coffee every once in a while. But that's different than going to Starbucks twice a day, 7 days a week, and spending $100 a week on something like that. I would rather own a home. Next slide, Shannon. Okay, so now that you've checked your credit and you got that in line, and now that you've made a budget and you've taken a look at what your expenses are going to be and you have an idea of what you can afford, the next step is to go get a pre-qualification for your loan officer. Shannon, you can hit the button one more time. And so with that loan officer out there, this is a huge resource which is free for you as a borrower. So now you can go out to your loan officer and say, here's my situation. What do I qualify for? And so your loan officer will walk you through it and they'll help you figure out the amount of monthly payment you can afford, the down payment amount you'll need to get into that first house, and the terms of the loan that you're eligible for. So you can figure this out yourself, but there's really no need to. You have an expert at the credit union. That expert, Christopher, is a huge resource. You also have experts over here like Centennial Lending or other loan officers, right? When you're ready to go buy a house, call your loan officer and have him walk through all the numbers, him or her walk through all the numbers, and try to have them figure out exactly what you qualify for, what your payment's going to be, and what you're going to need for a down payment. So now you have all those numbers that are sitting in front of you. You know that, hey, I qualify right now and I'm ready to go move forward, and I'm ready to call my realtor like Courtney and move forward and start buying a house. Or you're waiting to say, okay, I know what I need to do. I've looked at my budget. How can I affect myself? And how can I be at a place to go buy a house sometime in the next few months, right? We're going to ask for documents when we look for loans. So we're always going to ask for a mortgage loan application. Most of those are online these days. It takes about 15 or 20 minutes to figure out. We're going to ask you things like what you make and what kind of debts you have and where you live and how much your rent is, and if you have any savings accounts, or if you're employed, if you have a retirement account or anything like that. Loan officer is going to pull your credit report. It's going to be fine. It's not going to wreck your credit score by having your credit report pulled once or twice. as part of the mortgage transaction, and we have to do it to get the mortgage approved. And the loan officer may request to verify your income and assets stated on your application, right? So we're going to ask for things like tax returns. We're going to ask for things like W-2s. We're going to ask about your employment history. We're going to ask about paychecks and pay stubs, right? And we're going to ask for any kind of statements on savings or checking accounts, right? The modern mortgage process is us crossing T's and dotting I's and verifying everything, right? Just expect that we're going to ask for a pay stub and a W-2. And it's okay that you change jobs. That makes sense, right? It's okay that if you're a college student and you go out and get a job and you've only had that job for a couple months, that makes sense, and we need to go prove that, right? If you have money in a savings account, we're going to ask you for a proof of that, right? Same thing for things like down payments. We'll talk about that in a little bit, but if you're getting money, the mortgage process, we're going to check all that. So just expect us to cross T's, dot I's, ask for statements, and ask for a lot of information, right? You can fill out the application without providing that, but at some point, once you start down this road, just be prepared because we're going to ask for all that information. Next slide, please. You can hit the button a couple times. Okay, so you checked your credit, you've prepared a budget, you know what you can afford, you've gone to your loan officer, now you've seen real numbers, and now you're getting ready to buy a house. Let's understand what the mortgage payment looks like, okay? So when we pay our mortgage, a little bit different than rent, our mortgage payment is broken out into a couple different items. Okay, we're going to pay part of our principal. This is the portion of the loan amount that we're paying back to the credit union when they lend us money. We're going to pay any interest due. So that's a little bit of the portion of the interest. That's what the credit union's lending us the money. You've heard of interest rates. Mortgage interest rates are around 3% right now. They're really cheap. We're also going to pay your part of your taxes. Now, property taxes, we typically collect 1/12, so 1 month worth of taxes, and we collect that as part of every mortgage payment. Same thing with your homeowner's insurance, right? So when you own a house, we require as a lender that you have insurance on this house. In case the house burned down, in case you have a flood, in case something bad happens, a tree falls on it. We want to know that the house can get brought back to its normal condition. That's what homeowner's insurance is. Well, your mortgage payment, principal, interest, taxes, and insurance takes into effect all that. So as your loan payment servicer, as the person collecting your loan payment, I'm collecting 1/12 of your taxes every month. And then when your taxes are due, I'm paying your taxes for you. I'm collecting your insurance 1/12 at a time. And when your insurance comes due, I'm paying your insurance for you. Right? It makes it a whole lot easier as you as a homeowner just to make it as part of your payment. You don't have to worry about coming up with the money once a year. I'm doing that as your loan payment provider. And then we have this other stuff called mortgage insurance. And if you're using a low down payment purchase, if you're not putting 20% down, we're going to have this little extra thing called mortgage insurance. It's an extra little insurance policy that us, the lender, ask from you, the borrower, and it adds to your payment a little bit to guarantee kind of riskier loans and kind of low down payment loans. So when you get pre-qualified from your loan officer, what they're going to do is they're going to walk you through the dollar amount of the house you qualify for, the amount of the payment. The amount of payment will include all these items. Shannon, next slide. Okay, and then one last little thing about insurance. There's really two types of insurance. There's mortgage insurance. So that's something that you're going to pay the bank, the credit union, me, the lender, to give you a riskier loan, a low down payment loan. And there's homeowners insurance, or they call it fire insurance sometimes, right? That's the insurance that we're placing on your house, you're placing on your house. And so that's to guarantee things like fire or floods or trees falling on it or disasters or something happened, right? So you'll see little insurance, the different insurance. I don't really want to get too much detail to get into in the course of the next few minutes, but understand that that's all going to be out there. So all those things are taking place. It sounds a little confusing. The miracle of it all is your loan officer will walk you through this entire process, and they'll show you all the numbers, and they'll explain all the costs and all the fees, and they'll tell you exactly what your payments are when you go get pre-qualified. And you as a borrower want to make sure you understand all those numbers before you reach out to your realtor. I think that's important to understand too. Someone like Courtney, someone like any kind of real estate professional out there wants you to have your ducks in a row on the lending side before you go out and start looking at houses. Next slide. Okay, so I'm going to turn this over to Courtney right now, and she's going to talk about house shopping.
Perfect segue, Charles. Can everyone hear me okay? All right, I'm gonna hope that I am being heard. Thank you, thank you. Before I go further down this path, yes, to piggyback off of what Charles said, if you call me first and say, hey, I want to buy a home, the first thing I'm going to do is ask you if you've talked to a mortgage professional and send you to them first to go through all the process, all of the steps that Charles just outlined before you come back to me, and then I can pick up, and just like Charles said, he's there to guide you on the mortgage side of things, and I am there to guide you through the actual transaction process of finding and purchasing the home and checking everything out. And just an FYI, I assume that probably most of the people who are logging in to this class today, probably first-time home buyers. I'm going to make that assumption. Just know that if this seems confusing, we would expect it to be a little bit confusing. We would expect you to have questions. If you've never been through the purchase of real estate, it's a very, very foreign process. So I would never expect anyone doing this for the first time to understand all of the parts and pieces. And that's why we're here. And so I urge you to ask the questions, ask them in the chat so we can get back to them. There will be a Q&A. If you don't feel comfortable asking, you can always reach out to us privately after the class, but chances are, if you've got a question, somebody else listening in probably does too. So for the benefit of the whole community, go ahead and throw it out there on the open platform and let us give everyone the answer and clarification on that. So without further ado, do I really need a realtor? Technically, you could go about this on your own, but I'm not sure why you would want to for a few different reasons. And the biggest one is Colorado is a wonderful state in that in Colorado, your agent as a buyer on the buy side is typically going to be paid by the seller, okay? So you get free representation from an experienced realtor who can walk you through the process. Why wouldn't you want that? Especially if the seller has a realtor. So if they've got their representation working in their best interests, you ought to have representation working in your best interests and let them pay for it. The realtor, your realtor is going to be your advocate throughout the entire process. If you work with somebody who's experienced, they're going to understand how to write contracts, how to negotiate, if the asking price is appropriate, and every step of the process. There's a lot of legal implications involved in the real estate transaction that they can also help you through. So if you don't understand what earnest money is, if you don't know how to interpret a title commitment, if you don't understand the components of a winnable offer when you're competing in a multiple offer situation, if you don't know the difference between an objection deadline and a resolution deadline, or what a conditional sale deadline is, why you need an appraisal, and what are the factors that could make an appraisal fail, then you need a realtor, and it's worth reaching out to one. Go ahead, Shanna, you can go to the next slide. So buying a house is like marrying a spouse. I like to use this analogy to kind of give an overview of how does this process really go, okay? So after you've gone to Charles, you've gotten pre-approved and you have that golden ticket, that pre-approval letter, and you give me a call, we will start looking for houses. And the house search is much like dating. You go and you walk in them and you test them out, and you're gonna find ones that you just know on the first date, they're not gonna work. And some of them are great houses, but they're just not quite the fit. But eventually you're going to find the one, quote unquote. Okay. And that's when you say, we want to submit an offer. And submitting an offer is like getting down on one knee and proposing. And if the seller accepts your offer, then you start what we call the under contract period of time. And that's usually about 30 days. So the home search can take however long it takes to find the one and to have your proposal accepted by the one. And then it's about 30 days after the acceptance of the proposal. So that under contract period is much like being engaged. And when you're engaged, typically you stop dating other people, right? So you're just focused on that one house. You and the seller are focused on this transaction. And you get into the due diligence. This is where you kind of kick the tires, so to speak. And, you know, I equate the due diligence to kind of premarital counseling. Do I really want to marry this person? Do I really want to buy this house? So you're checking it out with inspections. You're going through any HOA documents. You're looking through title commitments to make sure that upon initial dating, you thought this was the one. Is it really still the one? And do you want to actually commit to the purchase? And then if all goes well, we get to the closing day, and that's like the wedding day. You give a whole bunch of money, you sign a whole bunch of papers, they give you keys, congratulations. You are married and committed. And if, you know, flaws and all, if anything goes wrong with the house after that, it's up to you to work out. Next slide. Okay, so this is a more detailed breakdown of my very simple analogy. And we're going to talk about these steps in the slides coming up. Go ahead, Shanna. Okay, when we first start out, you know, for some people, it's really helpful to have your checklist and to take some paper. And I've had people, you know, rank on a scale from 1 to 10. I've had people rank from 1 to 100. As we're looking at houses, I usually tell people, keep a rolling top 3 in your head. You know, your number one choice obviously is going to be the one that really catches your eye. And it's good to have a number 2, even a number 3, but once you get to, you're ranking them number 4, 5, and 6, they're probably not ones that you're going to want to offer on, you know, so just forget about those. Keep a rolling top 3. And besides just how the house looks and feels, there are some other considerations that you want to think about. Taxes, because as Charles said, that's part of your payment. So taxes are going to play into how much you're paying per month. The age of the home, some people want older homes, some people don't. How is that affecting maintenance issues? The age of the furnace, etc. HOA is another big one. If you're looking at a property with an HOA payment, a monthly, even a quarterly, that's going to factor in, because Charles said there's principal, interest, taxes, and insurance, mortgage insurance, and then that HOA payment is a flat fee on top of all of that. And you want to make sure that you're paying your HOA payments. So you want to look into that. You also want to kick the tires of the HOA. How well are they managing the community and the properties? Utilities, sunlight. If you've lived in Colorado for any period of time, you know south facing is nature's wonderful automatic snow removal. So, you know, if you have a south facing home, your driveway is going to melt that snow off quicker than neighbors across the street who are north facing. So if that's important to you, it's something to keep in mind. Surroundings and location, much like the house is like committing to your spouse, your neighborhood is kind of like their family and the in-laws. You marry the spouse, you marry the in-laws. And so you want to make sure that you like the house, but you also like the neighborhood and you like the location and distance to commutes and all of that. And it's good to visit the property at different times of the day, different times of the week. Now, in the market that we're in, you usually don't have a few days to go back a few different times before you submit an offer. You're going to see the house. You're likely going to submit the offer within the next day. But once you get under contract in that quote unquote engagement period, that's when you can go back at different times of the day and see, How active is the community? Does somebody leave their dog out while they go to work and the dog barks all day? You know, you saw the house initially on a Saturday afternoon. You're there for inspection on Wednesday morning. What's happening? You know, and is that okay with you? Go ahead, Shanna. Okay. So when you find that home, after you've done all the searching, taken all the considerations in, you go ahead and sit down with your realtor and you write that offer and you figure out your strategy for that offer. If your offer gets accepted, wonderful. Now you can just focus on all of your due diligence. But the first thing that's going to happen once the seller accepts your offer is you're going to submit earnest money. So there are a few different instances where you're going to pay some money out of pocket before you even get to the closing table. We're going to walk through those and then recap at the end. And the first one of those is that earnest money. So what is earnest money? Essentially, earnest money is a good faith payment. You know, you write up that beautiful offer, awesome strategy in the offer, great price and terms. It looks great on paper, but earnest money is a little skin in the game to say, hey, I'm really serious about this offer and I'm going to back it up. Earnest money is typically held by a third party during the process. So the seller doesn't put that in their own bank account, but it does come out of your bank account. And the big question is, how much do you need for earnest money? It depends. The seller is the one, just like they set their asking price, purchase price, they set their earnest money price and how much they want for earnest money. But just like purchase price, you can offer a little lower, a little higher than the purchase price. That earnest money line in the contract is actually blank. So you can talk with your realtor about the importance of hitting that mark, possibly going over if you need to go under, and kind of the implications for earnest money. But just know that could vary, okay? Will you get the earnest money back? Because earnest money is typically about 1% of the purchase price, okay? So that's a few $1,000s. It's not money that you want to lose. Most of the time, you will get your earnest money back. It is just not 100% guarantee. So the way Colorado, the contract to buy and sell for Colorado works, it's very buyer friendly, which is, again, wonderful news from the buy side. There are multiple ways throughout the contract, you know, that under contract period, that you can terminate the contract and get your earnest money back if you decide that this house is not a house that you want to purchase. And then, of course, if you close successfully, you'll get it credited back at closing, okay? Where you could lose the earnest money is if you're past all of your deadlines to terminate and it's a day or two before closing and you just change your mind, expect to lose your earnest money, okay? You're in default of the contract, you're not fulfilling your promise to purchase, therefore the seller has the right to keep your earnest money. But that rarely happens. A lot of sellers put a lot of weight in earnest money, but they rarely ever see it. So that's earnest money. That's going to be the first little bit of money out. Now, what should you expect in the market as you're crafting your offer and trying to figure out all of these different factors? Inventory is at historic lows, and demand is really high because our interest rates are also at historic lows. So it's simple supply and demand. We have super low inventory, super high demand. It means that on the buy side, you can expect that you will be competing. We are strongly in a seller's market. So the difference between sellers and buyer's market, if you're not clear, seller's market means sellers have the advantage. Buyer's market means buyers have the advantage. We've been in a seller's market since about 2012. So for almost a decade, it's been a seller's market. And right now we are very solidly in one, which means to strengthen your offer, you're going to want to consider, do I want to ask the seller to pay for some of my closing costs? Do I need to ask them to pay, or can I take that on myself? And closing costs are separate amount of fees on top of the down payment at closing. You know, do I want to go after every inspection item and ask the seller to repair everything? Or am I okay with taking on some of those myself and just asking the seller for the biggest things? These are all factors that go into crafting an offer. And can't tell you all of my secrets, but I would say this: offers aren't just about the purchase price. They strongly depend on the circumstances that you're in with that house and with those sellers. So that goes into the strategy. When you find the house, your agent is going to get as much information as possible about what the seller wants. You're going to decide what you want and see if you can craft an offer that's creative both on price, terms, and deadlines that works for both you and the seller to try and get it accepted. Next slide. Okay, so you make an offer, factors that influence purchase price, like we said, you know, inventory has been, low inventory has been driving prices up because demand is so high. You know, we talked about the repairs and the closing costs. Personal property, that might influence how much, you know, if you really want their hot tub, is that going to influence how much you're willing to offer on the purchase price? Now, this year, there's a new form for personal property and how that is all worked out. It can get very complicated, which again, if you have a realtor, they can walk you through all the pieces, you know, to decide, do you really want to be asking for everything or do you just want to keep it clean and straightforward? Contingencies and deadlines. So, you know, we have earnest money. We've got, if you talk with Charles and let's say you're doing a move up purchase, you already own a piece of property and you've outgrown it, you don't like where you live, whatever the reason might be, you want to move. Charles might say you have to sell that current property in order to buy your new property. And so that's an extra deadline in there that you have to work around when you're crafting your offer and when you're trying to negotiate in order to get that offer accepted, okay? Other deadlines that you're gonna see in the offer, HOA due diligence, title work to make sure that there's clean title, inspection, appraisal, your loan conditions, which is typically your last deadline, to make sure that your loan is good. Charles gives you the thumbs up and the clear to close and says, go ahead and move on to closing day with no issues. So you write all that up, you set all the terms that are acceptable to you, and you go ahead and you propose and send that over to the seller. If they like your price, your terms, your deadlines, everything the way it is in that offer, they might just accept it as is. Wonderful. Everything works for you, it works for them. If they want to change anything, you can accept to get a counter offer back where they say, you know what, we like everything except these few items. Here's what we would like to change. And at that point, the ball's in your court. You can either accept their counter offer with those tweaks, or you can counter back and go from there, or you can just walk away. Next slide. Okay, and so we talked about the money that you'll have to output before you even get to the closing. So there's an appraisal. If you're buying a property with a loan, as in not cash purchase, the lender is going to require an appraisal. And the appraisal costs some money. That is the responsibility of the buyer, typically paid at the time of service. It can be paid at closing. That's something that you talk with your mortgage specialist about. But first thing out is earnest money. Then you've got inspections. So I always recommend for buyers general home inspection. That's a given. But also in Colorado, because of our environment and our soils, I usually recommend a radon test or a sewer scope. Now, if you're buying a condo on the 3rd floor, you may not need a radon test. You probably don't need a radon test. But all of these tests, and these aren't the only tests that you can do. There are others: mold, lead-based paint, you know, structural engineer survey, land survey, and ILC. You can get as many inspections done as you want. Just know that each of those inspections comes at a cost, and that cost is due at the time of service that you get the inspection done, and that money is not refundable. So if any of those inspections bring up something that's a deal breaker for you and you say, nope, I'm sorry, I want to walk away, I do not want to purchase this home, you will be out that money and it won't be refunded, okay? Got earnest money, inspection, appraisal costs, and then that down payment comes when you go to close on the property. So your closing day is going to have down payment and closing costs. And the biggest cost, the biggest chunk of money is going to be the down payment and the earnest money. Okay, next slide. Okay, so that's essentially like a really simple summary overview of the process. Let's talk about the market because everybody likes to know what's going on with the market. What's the latest? I've been hearing things, you know, I see things in the news, you know, my friends, my family, they're purchasing properties, I'm hearing things. Well, let's talk about data because the numbers are what are important to me. These numbers are from Land Title. And this is specifically for September. We don't quite have all of the October numbers in. So we're talking about September, end of third quarter, and you can see it's for the 7 counties listed at the bottom. On the left, you've got your detached single family home. That's your typical single family, you know, usually with a yard. And then on the right, we broke out the attached single family homes. So that's your paired homes, your condos, your townhomes, any property where you share a wall with somebody, okay? Well, the first one that you can see on the left-hand side for detached is active listings, 2,500 active listings, and that bubble there shows that number is down. So an active listing is a home that's available on the market for purchase. No buyers have submitted an offer. They're waiting for a buyer to come along to submit an offer. So homes available for sale down more than half than this time last year, than September 2019. Inventory is so low, it's really kind of blowing our minds a little bit. But we think that part of that is because second quarter, we really had to hit the pause button. We couldn't have any showings. Real estate almost came to a grinding halt because of the pandemic. And that just created some pent up demand. So in third quarter, we're seeing a lot of those properties get eaten up, under contract, sold. You can see the sold account there for September. And so, you know, the actual available homes is really low. The average sold price is pushing $600,000, and that's up about 13% from last September to this September. Now, most of the time when you hear about sold price and we're talking about average home price, it's usually we're talking about averages. I prefer to work with median home price. You know, an average can be skewed depending on the most expensive home that's sold in whatever time period, if we're talking a month or a quarter or a year. For example, there is a property on the market in Golden listed for $30 million. When that sells, that is going to skew the average up for a short period of time if you're looking within that period that sells. A median home price is going to give you a little bit better idea. Median home price is less than the average home price, but still you can see what our low inventory over the last decade has been doing to the home prices. They keep rising, okay? Days on market, less than a month, homes are moving really quickly. And that's why I said, if you are looking to buy a property, expect that you're going to compete. You will probably have to submit an offer that's over asking price, especially if you are competing. You'll have to get creative on those terms and expect that you may not get the first one right off the bat. You may offer on a few and get beat out a few times and then finally find the one. But with a skilled realtor, you're going to get through that process, and at the end of the day, it will work out. I almost hate to put these numbers out there because they look big and scary, especially if this is your first time going through this process. Remember, the average is an average. There are homes under that price point, and there are homes above that price point that are available. And homes come on and off the market every single day, okay? So looking at the attached homes, you know, same figures, just a little bit different price. Average price for your condos, your townhomes is about $380. That's up a little bit from last year. But those active listings, again, are down pretty far, 25% there. And about the same days on market, they're moving just as quickly, okay? If you have any other questions about the process or the market, again, pop them into, oh, there is a question. How much as a percentage of the cost of house is required earnest money? Yeah, that's usually about 1%. Again, the sellers put that number, they decide on that number. So it could be a little higher, a little lower. Before you go to look at that house, you're going to know what they're asking for the purchase price, and you're going to know what they're asking for the earnest money. So you'll go in eyes wide open. Okay. If you have any more questions, I'll save them for the Q&A at the end.
Charles, you're currently muted.
A lot better if I turn my mute button off, right?
Thank you.
Sadly, it's not my first Zoom meeting. That's terrible. And yeah, anyway, so we're going to bust through a couple slides real quick. Loan programs, conventional is really about any mortgages, FHA, VA. You're going to hear all these terminologies. Don't worry about it so much. Worry about talking to your loan officer and know that they're going to put you in the best loan product that you are going to qualify for. Loan terms are fixed rate or adjustable rate, that ARM. Mortgage world, we call those ARMs. You don't really see a whole lot of ARMs these days. The fixed rates are so low. The mortgage rates are 3%, maybe a little under. And so those fixed rates really aren't on the table anymore. Back when interest rates were higher, sometimes you could get an adjustable rate for a little bit lower. Boy, we've hardly closed any adjustable rates in the last few years because the fixed rates are a better deal for the borrower and a better deal and the rates are so low. Shannon, next slide. I can click a couple times too. So getting your mortgage, minimum down payments usually in the 3 to 5% range. 3% is about the minimum we're doing right now. If you're a veteran, they have a 0 down program. Those down payment sources can come from a whole bunch of different locations. Remember, I said we crossed our T's and dotted our I's. So we're going to want, doesn't matter where the payment's coming from, the help with the down payment. It matters that we can track it and see where it's coming from. So it can come out of your checking or savings account. It can come from liquidation of stocks or bonds or retirement funds. A lot of 401ks allow you to take a loan against them. Again, loan against retirement account or personal assets. So we've actually seen people get loans on their cars. We had a guy get a loan on his Harley Davidson motorcycle for his down payment. They can come from gifts. Gifts got to be from family members, and we've got to be able to see where that money's coming from. So again, paper trails and all that. Proceeds from personal assets. Again, let's use that guy's Harley as an example. You sell your Harley, you got a bill of sale. We can see the money coming into your account as a deposit. Makes total sense. And then there are a lot of down payment assistance programs. And so if you reach out and contact your county or state or do a simple web search, most mortgage lenders, including us, can handle all those down payment assistance programs. This is going to sound crazy, but what's not allowed for down payment is cash. I don't want to hear about mattress money. I don't want to know that you just magically have $10,000 sitting in a jar buried in your backyard. I'm a mortgage lender. I'm a banker. I need to track that and I need to see where it's coming from. And then unsecured funds, cash advance on a credit card, personal loans. Again, I don't want to see any of that kind of stuff. It messes up your credit bureau. I've got to requalify you for all the debts and all that other stuff. It's not that you can't get a loan for the down payment. It's that I've got to be able to track it and see everything. Next slide. How much money will you need? Closing costs account for origination fee, lender's fees, appraisals, title work, just like Courtney was talking about, credit reports, recording fees. There's a whole lot of line items that come into your transaction. When you get pre-qualified with your loan officer, you're going to be able to see all of this information. We also collect the years of insurance up front, your homeowner's insurance. That's that fire, the hail damage, the trees and all that. You're paying a year of that up front. So then I can collect one payment every month, 1/12 every month. So then at the end of that first year, I have 12 months set aside and we can pay for it again. That homeowner's insurance and your taxes are called escrow accounts. So there's a little bit of money funded with all of that. Excuse me, I'm gonna sneeze. And your down payment. So expect to come up with about 5% of that purchase price to get that loan funded as far as that first-time home buyer, your 3% down and all your closing costs. Next slide. Once you have an accepted signed contract, you have to provide it to your lender. I put this slide in on purpose. It's super important. What happens is you get pre-approved from your loan officer. You go out with someone like Courtney and you pick out a house, you sign all your contracts, and then you get so excited about buying your house, you never go back to that loan officer who you talked to a couple weeks ago, 3 weeks ago, and say, hey, I've picked out my house. Here's my contract. One more button, Shanna. And so that contract has lots of dates to it that really matter. So when we have to give you loan approvals, all the application checklist information, when appraisals need to get done, your lender has to see your purchase contract. It's super important, and please don't forget about it, because that happens sometimes. And what happens is you forget to show your lender your purchase contract, you sit on it for about a month, and then you say, oh yeah, I'm going to close in a week. Well, it doesn't work that way. Your lender needs to be a part of that. Next slide. Mortgage stages. Processing and underwriting, you'll hear words like, hey, my mortgage is with my processor. When you get pre-approved, you've stated some facts and you've told your loan officer what you make and what you have for down payments and what's in your savings account and how long you've been working. Us as a mortgage lender, we're going to verify all of that. So we're going to get an appraisal. We're going to get that's a third party trying to figure out what your house is worth, telling us. We're going to check if you're in flood zones. We're going to check how much money you really have in your accounts. We're going to take a look at your pay stubs and your W-2s, and we're going to put all that stuff together. Once we all have all that together, we go to a final underwriter. So we go to a final double check on all our numbers to make sure your loan's approved. That underwriter reviews your income, your assets, reviews your credit reports, reviews the house, reviews the appraisals, and all of that. And then we're all working together, you, your loan officer, your realtor, myself, to get that loan done. Next slide. Closing your loan, you can hit a couple buttons. When you go to closing, bring your ID, bring certified funds for any of the closing costs that you haven't paid up front. What you're going to receive, copies of all your documents. You're going to receive all your loan documents. You're going to see all your purchase documents. And really cool, you get to get keys to your new house. And it's such a great feeling to walk out of that closing with a set of keys in your hand, knowing that you're a homeowner. And again, like I said at the very beginning, it seems like a confusing process. Understand you have lots of people that want to hold your hand and walk you through it. Don't get yourself hung up on individual loan products. Understand that Chris is going to help you walk you through this whole process. Don't get understand with the real estate process. Don't get hung up on it. Understand that you have experts like Courtney out there that are going to walk you through, find the right neighborhoods, find the right house, hold your hands, help you find insurance agents, and help you walk through this whole process. Everybody wants to help, and everybody can walk you through it, and you can go through this whole process, and you don't have to move forward until you understand everything, and lots of people will help you explain it all. One more slide. Shanna, I thought you were going to take over, but if you want.
Oh yeah, hold on. I will start my video up again.
Okay. Refinancing is a great time right now. Mortgage rates, if you have a mortgage on your house and you haven't refinanced in the last 6 months, now's the time. Rates are as low as they've ever been. If you've had that loan for more than a couple of years, it'd be well worth it to refi. Sorry, Shannon, go ahead.
Oh yeah, I mean, basically what you said, like right now is a great time to refinance, especially because rates are extremely low. So if you are looking to even start a mortgage, this would be a good time, even though there's a lot going on in the market right now. But reasons why you would want to refinance your home is, of course, get a lower interest rate, shorten the term of your mortgage. Fitzsimons has what's called a rapid refi mortgage. So, for example, let's say you originally had a 30-year term, you could shorten it to 20, 15, something like that. Anything longer, you'd be working with Centennial Lending, which is our partner. For example, you could also even convert, let's say you had an adjustable rate mortgage to a fixed rate mortgage, or vice versa. Each of these mortgages have their benefits or pros and cons. right now fixed rate mortgages are very low, and they're very popular because, you know, they're set in time and it's really easy to budget around. A lot of times adjustable rate mortgages, you can often get a lower rate than what you would get at a fixed rate normally. Just right now, fixed rates are very low, and adjustable rates, you will get a fixed rate for a certain amount of time. Sometimes that's 5 years, 3 years, sometimes it can be up to 10 years, and then it will adjust to the index or market. And that can be a little difficult when it comes to budgeting, especially if that rate increases significantly over time. But sometimes there is a benefit to having an adjustable rate. You can also use free financing to tap into the equity of your home as well. You know, so your equity is just based on, you know, what you have already paid against into your home, so you can borrow from that money, and then you can use that money for anything you want, really. A lot of times people use it for, you know, home improvement, but generally it's a loan that you can honestly use anything for. And it is being difficult for me to flip around. So like I said, equity is the value of your home minus any mortgage that you already owe, basically. There's other loans that we offer. There is what is called a home equity line of credit, which essentially is, I'm trying to think how to best explain it, sort of like a credit card in a way. You don't necessarily, you can a lot of times get pre-approved for a home equity line of credit or approved for it. And you can really, if you want to, you can borrow what you actually need. So let's say you get approved to have a credit of $20,000 and you only need, let's say, $2,000. You can do that. You can also have access to those funds over time, up to 10 years. This is often tied to, you know, the market as well. For equity loans, they're good if you exactly know what you need to borrow. So let's say you need to borrow $10,000, you get approved to borrow $10,000. You'll get that amount in a lump sum. That is a fixed rate, which is the benefit of that when it comes to budgeting. And then you'll have a set monthly payment, and those have a bit longer term, up to 15 years. But yeah, I just wanted to quickly go over that. We are opening it up to Q&A time. I did want to mention that there should be a poll that should have appeared. So if you could answer that real quick so we could just get feedback on this presentation. So we'd appreciate it so we could put more of these on in the future and we can learn more about what you're interested in. We will also be revealing the winner of our gift card at the very end as well. So if you have time right now, put in the questions that you have for Charles and Courtney.
Hey, Shanna, there were a couple questions that came in, and let me jump on one.
Yep, I see a few of them. So the first question we have from Anonymous is, how will the presidential election results influence the Colorado housing market?
Good question.
Good question. My take on it is it should settle things a little bit and bring the Colorado housing market down into some better level of equilibrium. It seems like things have been very confusing with COVID and the presidential elections and all that, and hopefully things will settle. What do you think, Courtney?
We typically see that activity does slow down a little bit before and a little bit after an election. Now, there's usually seasonality, you know, springtime activity ramps up. In the fourth quarter, it's usually slow anyway, but every 4 years in an election year, it's even a little bit slower. But I have heard traditionally interest rates are lower going into before the election and go up a little bit after the election, no matter who won. So that's what I heard about that. And yeah, you know, we see a little bit of an impact, but it usually always levels out. January starts new, it seems like, for everybody.
I kind of agree with that. I don't know if I'm going to see interest rates bump around a whole lot. Most of the projections we see, rates should be low around like this for the foreseeable future. Next.
Which is a good thing. Yeah.
Yeah, so that's a good thing. Means you qualify for more of a house.
Yeah. It looks like, Charles, this one's for you. Somebody asked about the difference in the different loan programs. I think that came on the conventional FHA, VA slide.
Yeah, it's, I can talk to this for 4 hours, or I can talk to it for, you know, kind of a couple minutes. You've heard of the company Fannie Mae, maybe heard of the company Freddie Mac. They're really the biggest purchasers of loans, and they really in the country, and they really set a lot of the underwriting guidelines. And so everybody kind of follows what the Fannie Mae's of the world do. And I mean, gigantic lenders, they fund something crazy like $1 trillion in mortgages every year. Most loans are kind of touching Fannie Mae at some point or another. Well, a conventional loan is a Fannie Mae loan, and that's where most of mortgages are going to kind of end up and be underwritten to. FHA is the Federal Housing Administration. They came around back in the 30s. You remember your high school social studies and the Dust Bowl and all that? And they're kind of an extra level of insurance to help lenders like us offer lower down payment loans. VA is the Veterans Administration. If you're a veteran, or if you're a spouse of a veteran or a surviving spouse of a veteran, by being in the military, you have a benefit, and they'll offer you a zero down mortgage. And so that's a pretty good deal. There's other programs out there also. It's easy to get in there and walk into a company and say, I want a Fannie Mae 3% down first time home buyer program on the Home Ready program because of this and that. You don't have to get hung up on that. Understand that your loan officer is going to drive you towards the lowest interest rate, best program they can find for you. And that will typically be the easiest loan to get done at the best rate. And so don't worry about the different loan products. Worry about that you're interested in buying a house. Call Chris, call your loan officer, get things started, and know they're going to drive you. There's no benefit to the loan officer to drive you through plan A or B or C or D. Hopefully that answers it.
All right. Just so you know, we have taken the roll for the drawing, and we have selected the winner. We will announce at the very end, but the winner has been selected, so we'll email them directly and we'll ask how they would like to receive their gift card. But just so you know, this event is recorded, so if you do need to go right now, we will put it on our YouTube channel so you can review it later. But if you want to put your Q&A real quick, feel free to do that right now. The next question we have is from Daniel Garcia. Do you make loans with ITIN numbers, or do you know anyone else that does?
Well, I'm going to answer this as I believe Courtney said, it kind of depends. And so, yes, we can lend money to ITIN numbers, but it's going to come down to a couple different rules that go along with it, right? So it depends on how you got your ITIN number, and it depends on what that kind of work relationship and ability to stay in the country and how we can prove that. And so the Fannie Mae's of the world, the big national lenders say, yes, it's okay for an ITIN number, but we're going to have to establish that you have the right to work for the next couple of years and that your work plans to hire you for the next couple of years. So can we do ITIN numbers? Loans, yes. They just tend to have a couple layers of difficulty with them, and it depends on how that ITIN number was set up. Do I know of other lenders that do ITIN number loans? I really don't. They've been kind of challenging, honestly, to get these loans done. And so, yeah, technically we offer them, but I'm not sure we can get them all done. Again, best thing to do, start with your loan officer and let's see what we can get figured out.
How long should you plan to stay in your home if you want to refinance?
Well, it depends. I love using that word depends. So it really comes down to, it's a simple kind of cost analysis, right? So it's going to cost you a few $1,000s to get a refinance, make a loan happen. You know, you got to value the house. And so the closing costs, and the simple math is you divide what your closing costs are by the savings of your monthly payment. And so when you go to refinance, people are really only doing a refinance for a couple reasons, right? They're going to refinance because they want to shorten their term. You know, like Shanna said, 30-year, and they really want a 15-year or a 10-year. They're going to stay in their house and they want to pay it off. That's one reason to refinance. The second refinance is to lower their payment. So they've got a higher loan payment. They got a loan at 4.5% or 5%. They can get a new loan at 3%, and that's going to significantly lower their payment. If you're planning to stay in the house, the lower payment matters. Doesn't really matter. If you're planning on moving in a year or two, that's when you got to go do the math on the closing costs versus the savings. The third reason you refinance is to pull cash out of your house. That equity is a hard to reach savings account, a very illiquid savings account. You can refinance, lower your payment, but you can also pull some of that equity in the form of cash out, and you can use that cash to send your kids to school or pay off your cars or credit cards or take a vacation and do all that. Pulling equity out of your house, it kind of goes into that next question about how do you tap into your equity. You can tap into your equity in a long-term first mortgage, 30 years, lowest payment, longest term. You can also tap into your equity through those equity loans or those home equity lines of credit. Those are a little shorter terms. Payments might be a little bit higher, but they're a little bit less expensive. And so again, if you've got equity in your house, you've owned your house for a little while, best thing to do, call your loan officer and explore your options. Pretty easy to write all these things out on a piece of paper, and it's pretty obvious to see what you're trying to accomplish by pulling that equity out. So is there a number that says, how long should I stay in my refi? Should I refi if I plan to stay in 6 months or a year? I don't know, maybe, probably not. If I'm going to stay in for 3 or 4 years or 5 years, yeah, probably. Look at the math and check the numbers, right? How do you tap your equity? Refinance your property and pull the equity out of the cash out refinance. Get a home equity line. Get a home equity line of credit. Oh, and I got one more question. So, what are the other first-time homebuyer incentives? A lot of the counties have programs that'll help with first-time homebuyers coming up with that down payment and down payment assistance, and so they provide grants and help getting those initial 3% down as a down payment. So, if you reach out to your counties, reach out to some of those down payment assistance programs. Again, ask your loan officer; they can help you explore ways to help with that down payment.
Let's see. Another question. Pulling out of my equity is still a loan, correct?
Yep.
Yeah, it's usually a separate loan entirely.
Well, so if you want to, in theory, pull your equity out without getting a loan, you're selling your house and you're just taking the cash and not buying a new house. Most people usually stay in their house. They need that equity to pay down debt or go do something or, buy cars, things like that. So I might be
All right.
confused about that.
I think, let me just double check if there's any other questions. Yeah, it looks like that is it. Does anyone have any other questions? All right. As I mentioned before, if you've registered, we have your contact information. So we'll send you a recording of this presentation and other helpful information as well. But for anyone that is watching the recording or anything like that, you could always contact us at marketing@fitzsimonscu.com and we can send any information that you need. As another reminder, if you are looking to get started on that home buying process, you can contact our loan officer, Christopher Lee. I have provided his phone number and his email. So when you are ready, just feel free to contact him and we can help you get started. And as mentioned before, we have selected the gift card winner, and that is Ashley. So congrats to Ashley. We will contact you directly to see how you'd like to receive that. And I want to thank Charles and Courtney so much for joining us this evening. And if you have not answered the poll yet, make sure you do that right before you leave. Thank you so much, everyone.
Thanks, everyone. Have a good night.
Have a great night. Bye, guys. Bye, Shannon. Bye, Courtney. Bye, Anna.